Can I tell you about something that happens inside your index fund while you're just living your life? No action required from you, no decisions to make, no research to do, no trades to place. It just happens quietly, automatically, behind the scenes, every single quarter. And most people who own index funds have no idea it's happening. But once you understand it, once you see how it actually works, you're going to feel really good about the choice to own one. Because this mechanism, this automatic rebalancing thing that nobody talks about, it's one of the most elegant features in all of personal finance. And it's one of the biggest structural reasons why index funds beat most professional money managers over the long run. Let's get into it. Okay, so first, let's make sure we're on the same page about what an index fund actually is. Because I found that a lot of people own them without fully understanding what they're holding. And I get it. The name is kind of boring. Index fund. It doesn't exactly scream exciting. But here's what it actually is. An index fund is a fund that owns a little piece of every company in a specific index, like the S&P 500. Instead of a fund manager sitting in an office picking stocks, the index fund just owns everything in the index, automatically, proportionally. The S&P 500 tracks the 500 largest publicly traded companies in the United States. So when you own an S&P 500 index fund, you own a tiny slice of Apple, Microsoft, Amazon, Nvidia, JP Morgan, Walmart, and about 496 other companies, all in one shot. And the key thing, the thing that makes it different from just owning a random basket of 500 stocks, is how those companies are weighted. It's not equal. You don't own the same amount of every company. The weighting is based on market capitalization, the total market value of each company. Bigger company equals bigger slice of your fund. As of early 2026, the 10 largest companies in the S&P 500 make up about 38% of the entire index. So when you buy one share of an S&P 500 index fund, roughly 38 cents of every dollar you invest is spread across just 10 companies: Nvidia, Alphabet, Apple, Microsoft, Amazon, and a few others. The remaining 62 cents is spread across the other 490 companies. Now here's where it gets interesting. Because this weighting isn't fixed. It changes constantly. And that's where rebalancing comes in. Imagine you have a playlist of the top 500 songs right now. It's a snapshot of what's popular today. But music changes. New artists break through. Old favorites fade. Some songs that were massive last year are totally irrelevant today. And some artists that nobody heard of 6 months ago are now everywhere. If you want your playlist to stay accurate, to actually reflect the top 500 songs right now, you can't just make it once and leave it alone forever. You have to update it regularly. Remove songs that have dropped off. Add songs that have climbed up. Adjust the order based on what's actually most popular. That's essentially what index rebalancing is. The index isn't a static list. It's a living, updating snapshot of the 500 most valuable public companies in America. And as the market changes, as companies grow and shrink and get acquired and go public, the index has to update to stay accurate. And when the index updates, your index fund automatically updates with it. That's the magic. Let's walk through exactly how this works. There are actually two types of updating happening inside your index fund at all times. And understanding the difference between them makes the whole thing click. The first type is continuous automatic reweighting. This one happens every single trading day without anyone doing anything. Remember how the S&P 500 is market cap weighted? That means every company's share of the index is tied to its market value. And market values change every day as stock prices move. So let's say Nvidia has a great quarter and its stock price jumps 15%. Suddenly, Nvidia is worth more, which means it makes up a larger percentage of the overall index. Your index fund automatically reflects that. NVIDIA now represents a bigger slice of what you own. You didn't have to do anything. The math just updated. And the flip side is true too. If a company's stock drops, say a retailer struggles and loses 30% of its value, it automatically shrinks as a percentage of your index fund. You're not stuck holding a full position in a company that's deteriorating. It just gets smaller, automatically. This is genuinely remarkable when you think about it. Your index fund is constantly, automatically shifting your money toward the companies that are growing and away from the companies that are shrinking. Not because anyone is making smart decisions, but because the math of market cap weighting does it for you. Winners grow, losers shrink. You stay diversified the whole time. No action required. The second type of updating is what most people mean when they say rebalancing, and this happens on a scheduled basis. The S&P 500 formally rebalances about once a quarter. This is when companies actually get added to or removed from the index entirely. So who decides who's in and who's out? There's an S&P 500 Index Committee, a group that reviews companies against a set of criteria. To be included, a company needs to meet a minimum market cap threshold, currently around $22 billion. It needs to be profitable, it needs to have enough trading volume, and it needs to be a US-listed company. Every quarter, the committee looks at the current list and asks, are there companies that no longer meet the criteria? Are there new companies that now qualify and should be added? On average, about 23 companies leave the S&P 500 each year, and about 23 new ones come in to replace them. That's roughly one company per index slot, cycling through every 20 years or so. And when those changes happen, when a company gets added or removed, every single S&P 500 index fund in the world has to update its holdings to match, automatically. Let's talk about the most famous example of this in recent history, Tesla. In 2017, Tesla was not in the S&P 500 at all. It didn't qualify. It wasn't profitable enough. Then in December 2020, after Tesla had finally demonstrated sustained profitability and its market cap had exploded, it was added to the index. And it wasn't added as a small position. Tesla joined as the sixth largest company in the S&P 500, with a weighting of about 1.5 to 1.7%, which meant that every single passive S&P 500 index fund had to go out and buy Tesla stock immediately to match the new index composition. There's an estimated $4 to $5 trillion that tracks the S&P 500. A 1.5% allocation means index funds had to buy roughly $75 to $80 billion worth of Tesla stock almost simultaneously. That's what caused the massive price spike in Tesla stock in the days around its addition. And on the flip side, General Electric. GE was once the most valuable company in America. For decades, it was a dominant S&P 500 holding. But as GE struggled, shrinking revenues, declining stock price, strategic missteps, it gradually fell in the index weighting. Your index fund automatically reduced its GE exposure as the company declined. You didn't have to make a judgment call. The market cap math made the judgment for you. This is what that article I read described so perfectly. The index is constantly being upgraded. Winners enter, losers exit. The index always reflects the current reality of the American economy, not the reality from 10 or 20 years ago. Now I want to make sure you understand what this means for you as an investor, because I think this is the part that most people miss. When you own an actively managed fund, a fund where a manager is picking stocks, that manager has to make the decision to sell a losing stock. They have to decide when to cut a position. They have to fight their own psychology, the reluctance to admit a mistake, the hope that a bad stock will recover, the emotional attachment to a thesis they've already committed to publicly. Human fund managers have all the same cognitive biases we all have. They hold losers too long. They sometimes chase winners too late. They have bad quarters and good quarters. and they charge you a fee, often 0.5 to 1.5% annually, for the privilege of having them make those decisions on your behalf. An index fund has none of those problems. There's no ego. There's no emotional attachment to positions. When a company starts declining in value, it automatically shrinks in the index. No decision required. When a company gets removed because it no longer meets the criteria, it's gone. Cleanly, systematically, without hesitation. The index doesn't hope a bad company will recover. It just reduces exposure as the market value falls, and then removes it entirely if it falls far enough. That's not a bug. That's the most rational investment behavior imaginable. Now, there's something I want to be honest about here, because I think intellectual honesty matters, and there are legitimate critiques of how index rebalancing works that are worth understanding. The main criticism is this. Because the S&P 500 is market cap weighted, and because companies get added after they've already grown a lot, the index can end up buying high. When Tesla was added to the S&P 500, it had already surged 700% that year. Index funds had to buy it at peak valuation, not at the value price. Similarly, companies that are removed are usually already struggling, which means the index effectively sold them after they'd already declined significantly. Some researchers argue this buy high, sell low dynamic creates a small but real performance drag, maybe 20 to 40 basis points annually. It's a fair point, but, and this is important, even with that drag, S&P 500 index funds have outperformed roughly 80 to 90% of actively managed large-cap funds over any given 15-year period. The imperfection of the rebalancing mechanism is real. It's just smaller than the imperfection of human decision-making, plus the fees you pay for it. The index isn't perfect. It's just better than most of the alternatives. Okay, so now I want to talk about personal portfolio rebalancing, because this is a different concept that often gets confused with index rebalancing, and they're related but not the same thing. Index rebalancing is what happens inside the index fund automatically. Personal portfolio rebalancing is what you do to your overall investment mix, your allocation between stocks, bonds, cash, real estate, and so on. Here's how it works. Let's say you decide you want a portfolio that's 80% stocks and 20% bonds. That's your target allocation, the risk level you're comfortable with. You invest with that 80-20 split. Then the stock market has a great year. Stocks are up 25%, bonds are flat. Now your portfolio has drifted. Instead of 80-20, you're sitting at maybe 84% stocks and 16% bonds. You're carrying more risk than you intended. Personal rebalancing means periodically selling some of the thing that grew too much and buying more of the thing that shrank. Selling stocks, buying bonds to get back to 80-20. It sounds counterintuitive, selling the winner. But you're not selling because stocks are bad. You're selling because you're maintaining the risk level you actually want. And there's a nice built-in feature here. Rebalancing forces you to buy low and sell high, systematically. When stocks crash, bonds hold up better. Your portfolio drifts toward bonds. Rebalancing means you sell some bonds and buy more stocks when they're down. When stocks surge, you trim them and add to bonds. It's disciplined, unemotional, and it works. How often should you personally rebalance? Most financial experts suggest once a year is fine for most people. Some say when your allocation drifts more than 5 percentage points from your target, so if you're 80-20 and you drift to 86-14, that's your signal. Vanguard's own research suggests annual rebalancing is optimal for most investors. 2 practical tips on rebalancing without headaches. First, if you have a 401k or IRA, rebalance inside those accounts first. No tax consequences. You can buy and sell freely to get back to your target allocation without triggering a taxable event. Second, instead of selling and buying to rebalance, try directing new contributions to the underweighted asset class. If stocks have grown and bonds have shrunk, Just put your next few months of contributions into bonds. You naturally drift back toward balance without triggering any sales at all. Clean, simple, no drama. Now let me zoom out and connect all of this back to why index funds work so well as a long-term wealth-building vehicle. The thing that makes investing hard, genuinely hard, is that it requires making good decisions repeatedly over a long period of time under conditions of uncertainty and emotional stress. When markets crash, you have to stay calm. When individual stocks struggle, you have to decide whether to hold or fold. When new sectors emerge, AI, renewable energy, biotech, you have to decide whether to chase them or ignore them. Most people, including most professionals, are not consistently good at any of those things. The research is overwhelming and humbling. Active fund managers underperform their benchmarks after fees at rates of 80 to 90% over 15-year periods. Not because they're not smart, because the market is incredibly efficient and the fees they charge eat into returns. An index fund sidesteps all of that. It doesn't require you to make good decisions repeatedly. It doesn't require anyone to make good decisions. It just owns the market, weights it by size, updates automatically as winners and losers change, and charges you next to nothing for the privilege. The automatic rebalancing, both the daily market cap drift and the quarterly formal rebalance, means your fund is always a current, accurate picture of the American economy. Not a snapshot from 5 years ago, not a bet on some manager's thesis. The economy as it actually is right now. And because the American economy has grown over every long period in history, creating new industries, new companies, new wealth, owning a continuously updated slice of that economy has been one of the most reliable wealth-building strategies available to regular people. Let's close with wealth moves. Concrete things you can do this week. Wealth move 1. If you don't own a broad market index fund, start there. A total U.S. market index fund or an S&P 500 index fund with an expense ratio under 0.10% is a perfectly reasonable core holding for most investors. VOO, VTI, FXAIX, SWTSX. These are all options worth looking into. I'm not telling you which one to pick. I'm telling you the category matters more than the specific fund. Low cost, broad diversification, automatic rebalancing. That's the criteria. Wealth move 2. Understand what you own. If you already have index funds in your 401k or IRA, take 10 minutes to look at what index they track, what their expense ratio is, and what the top holdings are. Most people have no idea. Knowing what's in your portfolio makes you a more confident investor, which means you're less likely to panic sell during a downturn. Wealth move 3. Set up a personal rebalancing schedule. Pick a date, January 1st, your birthday, whatever, and put a recurring calendar reminder to check your asset allocation. If it's drifted more than 5 percentage points from your target, rebalance. If not, close the laptop and go live your life. It should take maybe 20 minutes a year. Wealth move 4. Stop trying to beat the index. I know it's tempting. There's always a hot stock, a trending sector, a friend who made a killing on something. But the data is clear. Most people who try to beat the index end up underperforming it. Not because they're not smart, because the index is very hard to beat consistently, and most of the effort you put into trying costs you time, stress, and usually money. Own the index. Let it rebalance automatically. Add to it consistently. Leave it alone. That's it. That's the whole strategy. And it works better than almost anything else available to regular investors. I want to leave you with one image that I think captures all of this. Imagine an index fund as a garden that tends itself. Every season, the plants that are thriving grow bigger and take up more space. The plants that struggle shrink back. Once a year, a gardener comes through and removes the plants that have died off entirely and plants new seeds from the healthiest species in the region. You don't have to weed it. You don't have to decide which plants to cut. You just own the garden, and the garden keeps improving itself. That's your index fund. Growing, updating, self-correcting, all while you're out there living your life. And if this kind of clear, no-fluff financial education is what you've been missing, subscribe to Trek for Wealth. We break down the concepts that actually matter in a way that actually sticks. Your trail map for building, growing, and protecting long-term wealth. Trek for Wealth. Keep trekking.